Guys, so today we're going to talk about a very important topic, and that's the Fed and interest rates. I feel like often investors hear these words in the news or from other investors. They don't entirely know what it is or how it affects the stock market. So today I want to equip you with the knowledge of the other things that affect your stock other than the stock itself. You can make a brilliant investment, but it might not perform great in the short term because of outside sentiment. One quote I like about this is from Benjamin Graham, and Warren Buffett quotes it a lot, is, Mr. Market's irrational. He just is yelling out prices constantly. You know the true value of what you invest in, but Mr. Market doesn't. So some of the things that affect what Mr. Market's yelling out is the Fed and interest rates. And we're going to dive into it later with a special guest, Peter, who worked in the finance industry and does a great job breaking down some of these topics. My name is Jacob Braun. I'm the host of this weekly episode. I'm also a writer for Seeking Alpha and the founder of Braun Capital. I'm going to share my screen real quick, and I'm going to just give you a brief update on some stuff, and we're going to use our favorite tool, stockcard.io. If you end up getting a subscription to stockcard.io after seeing how we use it, use the code BEST of us at checkout just to let them know we sent you. So here I have pulled up the short 20-year treasury bond index, but there's many other indexes or things you can see for treasury bonds. So a treasury bond, what that is, I mean, I think most investors know that is basically you're giving the government a loan, they're giving you back in the form of a bond. So when a bond, the thing with a treasury bond is it is affected by the Fed and its interest rate. And I'm going to dive into that real quick on the tool, and you can see on the price, whenever the price here is falling, what that does is when the price falls, the yield, which is consistent, actually increases. So the yield percent increases because it has a set payment it has to make. And that's the same for any stock. If a stock falls, your dividend yield is actually going to go up. So we talk later about this in the video segment, but you see these 1 to 3 year treasury bond. This is an ETF, but it's beginning to fall, which means your percent is going to increase. And the reason it began to fall was because the Fed increased interest rates and is expected to continue to do so. So what is the Fed? And we're going to talk about that later. And what is the interest rate? We're going to talk about that later in the video. But it's important to know that these topics about how the bonds are affected and how it will affect other things. So when a bond becomes cheaper price, the yield goes up. So let's say you can get a 4% return on a bond. If you can get a 4% return on a bond, you're less likely to go and invest into a risky asset because you're not chasing big yields in another asset because you have a very for sure yield in a certain asset. Because as you can see right here, low risk and low cost. Bonds are the safest investment that you're going to make, especially a treasury bond in the stock market. And because of that, whenever you can get a pretty good return on that, many investors are just going to go to that because they want the for sure return and not to have to deal with the crazy stock market. So whenever people are moving their money into bonds, that means they're moving it out of the stock market, and typically it follows a pattern. So people move it out of very speculative investments into a little bit safer stocks. So for example, they might move it out of high growth tech, early biotech companies, and move into a little bit safer companies like industrial staple companies, or some of those big blue chip companies are a little bit more stable. And the people who are in those companies are going to move it to even safer investments, maybe going into high dividend yielding plays that are just a little bit more stable. And people in those plays are going to slowly start moving into bonds. And so what that does is it pulls money away from risky investments and into safer and safer things. And what that does is it really affects those high growth, high potential companies, removing capital from them and as a result, losing the share price. After this, we're going to hop over to this interview with Peter. I hope you enjoy it and definitely check out some of his stuff. He's had some really good content out there. Hi, everyone. This is our interview discussion segment. We're here with Peter. Peter, would you be able to introduce yourself?
Sure. Thank you for having me on, Jacob. My name is Peter, and I am a former full-time macro trader. Usually was involved in the quantitative space for quite a long time. Did that for almost a decade, and now I'm a full-time data scientist over at a insurance company. But I'm still quite actively involved in markets and on Twitter and YouTube, etc. And Jacob was nice enough to have me on to talk a little bit about markets.
For sure. Thank you for that, Peter. So I found Peter actually on Twitter. He does very good analysis on different plays in the market and like kind of how stocks are moving. So I thought it would be great to have him on to be able to talk about some topics. And one topic I really wanted to talk about was just the Fed and interest rates, because so many people are throwing around these words and saying what it's going to do to different markets. But I think many people don't understand like the basis behind it. And so I mean, the most simple one is, what will a rising interest rate do to the stock market? Peter, would you be able to give us some more insight onto that?
Yeah, it's a good point. I mean, we haven't really had inflation in 20 or 30 years. And I think now it's like gurus are all over the place giving their opinions on like, really in the weeds, deep stuff that have no real context to kind of everyday investing. And I think it's good to take a high level approach to just kind of define what matters basically. So let's just start with, what is the Federal Reserve? Well, it's just it's not a private organization, but it is kind of controlled by, it is heavily influenced by the Treasury. It is a self-governing organization, but it's not officially kind of part of the government. And they set interest rates basically. And what that means is they set the overnight deposit rate that banks pay for lending. And, so like for a long time is basically 0 to 25 basis points, which means that's an annualized rate. That's how much banks would pay overnight to borrow from the Federal Reserve for liquidity purposes. Now, if that rate was jacked up to say 1%, well, what does that mean? That means that, okay, the cost of a mortgage is going to be higher for the consumer because the net margin for the bank needs to increase almost the same amount that they're paying for that for the capital that they're getting from the Federal Reserve. So, yeah, it's quite important because it dictates liquidity, it dictates credit, how easily they're going to be giving out. And it kind of increases tightness in the system because if if things are loosey goosey, they can borrow money for almost nothing. The banks, they're going to be very willing to give out credit for expansionary reasons. It's going to be much easier to get a business loan, to get a mortgage. It's going to be very cheap. But when things are a little bit more tighter, when the Fed starts increasing interest rates, basically that becomes a little bit more difficult for the bank just from a profit margin perspective. Okay, they need to think like their costs are increasing, so they're going to be a little bit more fine-tuned about who they're lending to, why, et cetera. So that's kind of the big backdrop of why that overnight rate matters. Now, Jacob, you asked, why does it matter for investing? Well, it's kind of like as that interest rate goes up, treasuries also come down, the bond prices. Why? Because treasuries have to get discounted for a higher rate. And when that happens, the price of a bond goes lower because that bond is now worth less because the interest rate went up. Now, there's a big kind of, I don't want to get like too technical here, but there's always a trade-off and flow in the market. Like at some point, treasuries become too cheap. Okay.
Yeah.
And that when interest rates gets too high. And what that means is maybe it's more worthwhile to invest in a treasury than it is in the stock market. Like for example, the S&P 500 dividend yield is around like 3%. The 30-year bond is now trading close to 4.5% now. So it's you're getting actually a more higher return from a 30-year treasury bond than you are from the S&P 500 dividend yield, which is kind of crazy to think about. So as soon as like that switch happens, investors might flock some of their assets out away from high risk stuff like equities, and they might transition that money back into treasury bonds. That's just one example of that kind of give and take where investors might seek a much safer return from treasuries versus getting involved in the stock market.
Yeah, for sure. And so kind of touching on that, where how when the guaranteed interest rate, the guaranteed return rises, people are more likely to put it in there. I heard a great research study on this very topic. So if you ask someone if they would make an investment for a 10% return versus a 5% return, so double the return, double the risk, most people would choose the safer and the safer 5% because they don't want to take that extra risk for that. But if
Yeah.
you gave them the same scenario but with a much lower percent, for example, like 2 and 4%, most people will go for the higher 4%. So when there's a guaranteed higher percent for return, most people will lean towards that safer investment. But when there's everyone's chasing for that yield, then people are going to put it in more speculative and risky investments. And I think
Yeah.
this kind of plays kind of nicely into another topic that's very hot, which is crypto. Some people see it as kind of the next currency or a hedge against inflation, but many people I think see it as a speculative asset, or it kind of, and it right recently it's been trading with very high correlation to tech stocks, which are high growth companies. So
Yeah.
with that, how would inflation rates affect crypto and those like high growth tech companies?
It's a really good question. I think let's just start off with the high growth companies. So, why are they high growth? Well, because basically their prices today reflect their growth in the future,
Yeah.
right? That's the basic definition of a high growth company. And well, what happens when interest rates go up, um, and you're valuing your company for the future? Well, you have to discount that company's value for today's interest rate. So when interest rates goes higher, actually the value of that company in the future actually decreases. That's just a classic net present
Mhm.
value formula. So as interest rates go up, and we actually saw that, when ARC funds or whatever topped out in 2018, that was
Yeah.
kind of like the first iteration when rates really started to go up. The direct impact is actually high growth beta, whatever tech
Mhm.
beta starts to really come off and underperform the market as people kind of flock out of bonds or whatever. So I think that's the first reaction, and I think maybe we're sort of in the late innings of that, because obviously a lot of those stocks are kind of off. Some of them are off like 70 or 80% off their highs. I mean, at this point, some of them, could be considered some value plays there. Of course, it's hard to foresee how long high inflation regimes will last, because we literally have not seen this kind of
Yeah.
market environment in decades,
Decades.
decades, decades. It's really quite interesting. And nobody has ever seen a bond bear market basically, in
Mhm.
20 plus years. There's been a lot of people who made really great fixed income careers. Basically for the last 30 years, we've been in a massive bull market, and it's a completely different regime. So yeah, it's tough to say how long an above average inflationary environment will last, because I think during COVID, I'm getting into a little bit of a tangent here,
Yeah,
but
for sure.
during COVID, I think we set a lot of interesting precedents of what
Yeah.
a central bank could do. Like, for example, stimulus checks. I don't think anybody had
Mhm.
on their bingo card that President Trump was gonna do a stimulus basically check,
Yeah.
give away, and that I think that was something that took actually quite a long time to play out into the markets,
Yeah.
from an inflationary standpoint. And we're only seeing that kind of stuff come into effect now from higher energy prices, et cetera. And so I guess what I'm saying is kind of policy things that happen. It takes maybe years sometimes for those things to come into
For sure.
fruition. And right now we actually have a lot of debt in the system, and a lot of first-time home buyers can't even afford mortgages because
Mhm.
mortgage rates just skyrocketed at 5%. And you have to think about, well, how are they going to enact policies to influence kind of young people to start to buy homes or whatever? And
Yeah.
what's the most obvious way to do that? Well, maybe they'll start canceling student debt for first-time home buyers. And I can't even imagine the
Yeah.
the inflationary impacts of something like that if just student loans start to get canceled out slowly and surely. So yeah, we might be in a higher inflation environment for quite a long time. So back to your kind of original
Yeah.
question, maybe tech stocks and high growth stuff might be underperforming for years. We've just
Yeah.
had 10 years of one of the greatest tech bull markets in quite a long time. But yeah, maybe if we're going to be in an above average kind of inflationary situation, that could
For sure.
those might be sideways for the next 5-6 years. Who knows?
I think the biggest thing to bring out of all this is that the Fed interest rates are a very complex situation, and it's not just one thing. These are heavily influenced, one, by the stock market's performance, and number two, by things such as the unemployment rate, which is another thing that the Fed helps play with, and then finally, probably the most important player in it is actually politics. Monetary policy by the government has a massive effect on the markets and on what the Fed does and does not do. Technically, the Fed is not a political body, but whatever the political politics of the day are will affect what the Fed does and will affect the stock market.
Yeah, they are quite reactionary to what the markets do, which is, I've actually found it really interesting that for all the volatility that we've seen in the last couple months, that they're actually so kind of honed in on raising interest rates right now,
Yeah.
especially given how basically the yield curve inversion, which is when short-term interest rates are higher than long-term interest rates, has basically predicted the last 9 out of 10 recessions.
Yeah.
I find it a little bit interesting that they're so on the beat about being very hawkish at this moment. And hawkish means just like they want to normalize interest rates to a healthy level relative to where inflation is. So it is really quite interesting. And there's definitely some very interesting behavioral psychology things that go on because, they're a board of directors, just like a regular company is, and they're influenced by, people and pressures within the organization themselves. And, so it must be a very hard job to sit there and make these kind of decisions because they basically, back in 2018, they did the same exact thing. And, we basically saw the markets come off 20% in 2018 after the 2-year yield got to like 3% basically. And the markets are only off like 6 or 7% off their highs right now. But and we've only raised rates once. So if they keep, being on this hawkish footing, I don't know, it might not bode well for, risk in the medium term, but
For sure.
yeah.
And yeah, again, the more and more we talk about it, it just emphasizes the point that this is just one of a multitude of things that affect the stock market. It doesn't matter necessarily always how good of a company it is. There's outside forces that are going to affect your investment. And I think that's it very important to know and to learn about those outside forces. So one, you can understand better if your stock's falling irrationally, or you can better understand when or how to buy a stock.
100%. I think one of my favorite quotes is actually from Steve Cohen about this is just about general markets. So if a stock move is broken up by 100%, 33% is the underlying business of that stock. The other 33% is the sector, and the other 33% is what the general market is going to do. So right there, if you just believe in that very simple kind of framework, 66% of your stock's direction has nothing to do with actually what the underlying business is. And for example, like if you're a biotech investor for the last 2 years, that must have been very tough. Why? Because, I mean, during COVID, how are you going to run clinical trials? You can't even get your people into the office. Your cost of doing business has just increased exponentially. And especially a lot of these biotech companies are high growth companies. So
Yes.
they might not have a lot of cash on hand, and they might need to raise equity quite a lot. And your cost of financing just basically doubled, and you're still having a hard time trying to get back to the office to do all this stuff. So just, some of your biotech stocks that you might own, they might be 100xers in 5 years from now, but they might drop 50% now, and that doesn't really mean that you necessarily own a bad company. It's just there are market forces in play, and this has nothing to do with the Fed. So yeah, Jacob, you're absolutely right. There are so many different inputs in investing that we should all be aware of, and it's quite difficult to balance all those things at once, especially when you have a portfolio of a lot of different stocks.
For sure. And that's why at the end of the day, when I make an investment in a company, I base it around an investment thesis. So I invest for a reason, and that reason has to be a strong reason, because whenever something happens, I have to be able to come back and re-examine that thesis to make sure it's either true, or if it's changed, be able to act on that change.
Yeah, I think having a crux, something to rely on, is like probably the most important thing. I think a lot of the time, like you would go on Twitter or find a website and somebody has this chart pattern that works 80% of the time or whatever. And I think that's BS. I think it's very tough to just be a pure technical person. And don't get me wrong, I love technicals, I love charts, but I think you always have to have a reason for doing what you're doing. And if the stars align on the charts, that's even better. If you have some data point, if you have some quant signal, that's even better. And I think at the end of the day, it's all about getting the wind at your back, as much objective information as you can for making a good, sound decision, basically.
Yeah, for sure. Thank you so much for coming on. Real quick, do you have any final words? And then also, where can we find you?
Final words. I wish I had more strong opinions. I mean, I think maybe inflation might be on a CPI headline basis. We might be topping out. I just don't think we're going to have 8% inflation year over year consecutively for the next few years. I think we're quite extended there. And as a consequence, maybe that means bonds might start to maybe hold a little bit in the medium term. And maybe as a consequence of that, maybe tech stocks might start to see a little bit of a inflow. But that's basically that's a wait and see kind of thing. Just I don't think these trades should have any FOMO because we've obviously just had a cyclical decline that could take some time to start to get institutional investors comfortable into investing again, et cetera. So no rush to jump back in, but something I'm looking out for sure. And yeah, you can find me on Twitter. It's just PETR_BZ. And my website, which is just a blog that I run, it's called investorcharts.net. And basically, I'm just sharing intel on a day-to-day basis about stuff that I'm looking at and a lot of the topics that we discussed here today. And it's thematic, and some of these new subjects changes day to day. Tomorrow it could be the NFP numbers that came out. Why is it important? So
and what's your YouTube channel?
My YouTube channel is PETRBZ, no underscore, no nothing.
Okay, perfect. Yeah, so thank you so much for coming on here. Thank you everyone for watching. Like, share, and subscribe for this video, and definitely check out some of Peter's things.
Thank you very much, Jacob, and thank you all for watching.